Have you wondered how to calculate return on investment for real estate assets? In this video, I'm going to show you how, and by the end of it, you'll be a professional at not one, not two, but 4 ways of calculating your return on investment for real estate assets. Make sure you keep watching all the way until the end. Before we begin, we need to set the parameters. Type of property, it's going to be a new launch, also known as a BUC, building under construction. The price would be $1 million, which will be paid for using a 25% down payment and a 75% loan. For your costs, we would add your buyer's stamp duty of $24,600, your legal fees, approximately $2,500, and miscellaneous fees. I assume them to total about $27,000. Then we assume a holding period of 3 years, where during this holding period, you have mortgage repayments approximating $18,000. Okay, so I want to add these two up together. You get about $45,000 estimated over a 3-year holding period. And at the end of 3 years, your selling price, I'll assume that net of expenses works out to be $1.1 million, and your outstanding loan is $700,000, which means if you take $1 million minus $700,000, you get back $400,000 cash. Make the assumption that you are not using any CPF for this purchase. Now, pause the video. I want you to try and work the answer out yourself first before I proceed. I'll give you 5 minutes. Pause. Ding. Time's up. Let's dive in right now into the first method, the return on investment. This is one of the most traditional and straightforward ways of calculating the return on a real estate asset. What you do is to compare your buying price versus your selling price, which in this case you bought at 1 million and you sold at 1.1 million. Using the return on investment method, you will take 1.1 divided by 1, which gives you a 10% return. This method is the most straightforward method of calculating return when you don't have too much details of the transaction. All you need is the selling price and the buying price. You don't need to know the specific details like what I've shared with you, such as whether there was any loan taken, how much is the loan amount, how much are the mortgage payments during the holding period. All you need is the buy price, the sell price, which are publicly available information. Hence, it's an easy method. Moving on to the second method. This is known as return on equity, where you take your net income from the property compared to your equity, which in other words is your total cash outlay in terms of a real estate investment. So your net income, how much is your net income? Your net income is your profit from the property minus away your expenses. As your property appreciated from 1 million to 1.1 million, your profit is 100,000. Less expenses, as we got earlier, is 45,000. So your figure for the net income area would be 55,000. Equity is the amount of cash you put in, which is equivalent to your down payment plus all other costs. That's 250 plus 45 equals to 295,000. Okay. Then you compare these two figures. What you get is a return of 19% when rounded to the closest whole number. Some people say that this second method, return on equity, is more accurate than the first one because you don't exactly take the full purchase price. Instead, you focus only on the actual amount of cash outlay equity that you put into the purchase. Next, the third method, which is in fact similar to the second with a slight alteration. Some change the return on equity portion to be instead a return on expenses. They do that by taking the equity minus away the principal payments. Principal payments is your down payment figure. Why so? People who suggest this method say that the principal amount, the 250,000, is money that you put into your property at the start, and when you sell it later at the end, you get it back in your selling price. Hence, it's not a cost per se and shouldn't be used in the calculations. Well, let's see what's the return from this method of counting. Okay, your return would be the same as in the previous example, which is 100k minus your cost, 45k, which you get 55k. However, now in the denominator portion, your equity minus principal would be 295k minus away your principal payments, which is 250k, the down payment amount that you get back when you sell the property. Here, you get 45k. Taking this 55 divided by 45, you get 1.22, or in other words, a 22% return on your real estate investment. Notice the numbers I've given you for each method just keeps increasing. But I don't stop there. There's still a fourth method, which I call the cash on cash return. For your cash on cash return, we are only looking at the money out versus the money in. Straightforward, I add up all the costs, which is your down payment of 250 plus your ongoing cost of 45k to get 295,000. Wow, your money in at the end is your selling price of 1.1 million minus away your outstanding loan of 700k to get 400k. The next step is to take 400 divided by 295, where you get 1.36, or in other words, a 36% return on your investment. That's a round up of the four methods. Let's do a quick recap. The first method, return on investment, gives you a 10% return. Second method, return on equity, gives you a 19% return. Third method, return on expenses, gives you 22% return. And finally, the fourth method, cash on cash return, that gives you a 36% return. Don't you find it interesting that for the same question on the return on investment for a real estate asset, there can be so many different answers from 10% all the way to 36%? Let me tell you this, there are many people in the market that says many different things. Do they really know what they're saying? What's the answer you got? Does it tally with any of my answers? Which do you think is the best method? Or if you don't agree with any, what do you think is the best method? Let me know in the comments below. I know what's my best answer. If you like this video, make sure you do click the like button, share it with a friend who would find it useful. Remember most of all to subscribe so that you don't miss my next video where I tell you what's the best answer. See you soon.